Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with my good friend Bruno, who's going to be talking about the Rhino trade today. But before we get started, a quick disclosure: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. If you don't know your situation and have no way of knowing what level of risk is appropriate for you, we're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that, this is for educational purposes only. It's the red there. And if you want to just read the whole thing, just pause the video or look at the bottom of our web pages. So with that, Bruno, I'm going to stop sharing my screen and you can go ahead and share yours.
Right. Okay, but oh, exit full screen. Okay, because I need to get back to. Okay.
Yeah,
okay.
There's a little green share thing at the bottom.
Right. Okay. Desktop.
Ah, there we go.
Play slideshow.
I see a rhino.
Yeah, my favorite, almost my favorite animal. Yeah. Yeah, I mean, actually, it's the leopard, but okay, maybe later there will be a leopard strategy. Who knows? Okay, so you see the rhino. In this presentation, I'm not going to go back to all the rhino basics. I think the guidelines are known, and there have been previous presentations on this. So basically, I'm just going to review how the rhino trade had to evolve in this crazy market we've had in the last, well, almost like 18 months. So yeah, I mean, I could have complied with the original rules, but I could see that some things were not going right. So I wouldn't say I went exactly with the flow, but I did my best to try and make it evolve. And I suppose all strategies have to evolve in a market like this. So the year in review, we'll start with, okay, this 2017 was a bit like 2007, 2013. Pretty difficult years for most butterfly strategies, having been completely quashed. I think last year was even worse than the previous occurrences of this, with even the VIX as a proxy or any form of benchmark, going back to almost 25-year-old lows or all-time lows. And I suppose many of you butterfly traders have experienced the same thing as I did. Basically, lower premiums, more expensive brokering butterflies. I hope, I mean, all the jargon like BWB, all this is known. I mean, I suppose there will be questions. Slower profits. Profits take longer to mature, and I've had to keep the positions much longer. In the original guidelines, there are different stages of profit taking, from 35 DTE down to 14 DTE, but sometimes we have to go even after 14 DTE, even though it's more difficult to trade. The other thing that really we had to deal a lot with is the capital restraints or constraints. When there's in a low IV, not only it's more expensive, but and because it takes longer to get into profit, the next cycle has to start. And in the original guidelines, which I've tried to keep as much as I could, we had a planned capital for roughly 1 cycle and a half. Basically, you had time to exit the trade as you build up the next cycle. In this environment, we've had to go sometimes through 3 cycles, because if you enter early to get a better pricing and you have another cycle more in I would say in cruising altitude or being more mature, you have the third one, which is at the end of its life. So I've had to juggle a lot more with capital allocation. Of course, I could have said, well, this trade is not only for PM traders, or I could have increased the planned capital for the trade. Which would definitely have made my life easier. But I've decided to stick with the same planned capital as in the beginning. Sorry. Sorry, there was a bit of an interruption because of a call. Although my Skype status is busy, do not disturb, but some people don't actually take it. Well, so juggling a lot more with capital allocation. And as we are going to see, it's been also a question of chasing the market for theta. Basically, try and extend a tent with the rising market, but to an extent. So we're going to have a look at that, and also, of course, that will lead to the mutations or changes in the strategy. Overall, the year was not so good, plus minus 20%. Effectively, I made about 17% because I lost a bit of money on some hedging strategy, hoping or expecting a reversal. But on the Rhino itself, it's about 20%. So, of course, in this market, I had to make the strategy evolve, as I said. And we're going to have a look at a few examples. Also, I had to make this. I mean, this is probably a personal choice, but the trade, the Rhino trade as it is, does thrive, or at least do well, and of course most market neutral strategies and the ranging market. So when the market has no high, no peak, no cap, we have to be a bit more conservative. Also because of the possible whipsaws, which we haven't seen. I mean, because buyers always came back in any dip, but of course this will happen. So when will it happen? So I had to make it a bit more conservative. Sadly, because when I took over from Brian Larson, there were some expectations of a quasi-mechanical trade. So I've lost a few beginners in my clients or students, but I think I've gained also traders who are more willing to learn and adapt. So this Rhino strategy has become probably slightly more generic, but in a way it's probably more advanced, and it will keep on evolving. I mean, we are here to make money after all. So this is the performance over the last 18 months. It has not as smooth. That has not been as smooth I would want to. And as you can see here, I can't see my mouse, but anyway, I've had a bad month for the November cycle. So we're going to go through that right now. So the average gain was down to about 2%, and this strategy should make on average 3, 4, or maybe 5%. But of course, the market environment was not conducive to that. So what happened to November? So let's start with the bad news. Yes, November went wrong because after the low we saw in mid-August, I think it was about 2,400 or 2,425, the markets started shooting up again, and the entry was on a low IV. And I made a decision, because it's actually part of the guidelines, to roll over the brokering butterflies. So I took a loss on the lower butterflies, and I sold I bought the new ones a lot more expensive because of the very low IV. And to my surprise, the call calendar hedges on the upside did not work very effectively. So I will go back to that, and that was actually the reason why I've had to change the way I trade the Rhino. The Rhino had already changed marginally because, of course, the the bull market hasn't started in August. I mean, it started right after Brexit, or and second on the second stage after the presidential elections. So I had already changed a few things, but now I've changed it probably a little bit more deeply. And that's why I say the Rhino, as it is now, is could be called a more generic broker wing butterfly trade management. So let's recap a little. The capital usage also, or planned capital, I use 25K Reg T capital per monthly cycle. I never exceed that. There have been exceptions which I've always corrected over the next day or two, but I mean, and I've never exceeded the 37.5, basically the 1.5 cycle, the 1.5 planned capital for each trade. Although it's been, as I said earlier, with a balancing act on capital allocation, it's been very difficult because often, I mean, in a normal IV environment, we have 2 trades on, and we've had now, because we kept the trades longer, up to 3 monthly cycles. So the regular, what I call the reg trade, is the one I use with 37.5K, and that's my offshore track record. That's the one that you saw on the chart earlier. And I try and exit by 14 DT as per the original guidelines. But for people who trade like me on a PM account, I've now, I mean, initially it was the spin-off of the extended trade was only to trade. Initially, it was really for people who were prepared to take the trade to expiration week. But it has also become a slightly less conservative trade. And also, it's an easier trade because of the capital reallocation and constraints. This trade is still doing fine on a PM account because we have far less scaling out to do, because we can keep 25K up to expiration on the current cycle while we're still building up the next cycle. So it's because of, I would say that now in the last year or so, probably of more than half of my adjustments were justified because of capital allocations more than by the strategy itself. It's been an easier trade on the extended trade, and of course by keeping more capital into a trade, longer into the trade, the extended trade has done better, even though it's not showing on the track record. As a reminder, and also for people who want to a scalable trade, possibly for those who want to trade larger amounts, I also stick to 25-point strikes on SPX, which are the most liquid strikes, and 10-point strikes on RUT. At the moment, I'm not trading it on RUT. I'm not saying it's more difficult. Actually, it's probably the same. Basically, the skew is easier on the RUT, so we have probably a flatter T+0 line when we start a trade. And also something I've changed from the Rhino I took over from Brian Larson in June 2016 is that I've decided to go wider. So the typical broker wing butterfly will be a 100/75 wing butterfly versus 80/60 originally. Another quick reminder as well, the typical scaling is that we add another tranche when the underlying moves out of the tent on the upside by more than 1%. The original guidelines were only on the way up. I've generalized that to scale in, providing capital is available by 56 DTE, regardless of market movements. So but most of the time in this market we've had, it's been difficult to go to full size. So typically we would go, full size would be 6 80-60 SPX broken wing butterflies, or 5 for the 100/75 wing broken wing butterfly, and for the rut Rhino, which hasn't changed, it would be 5+5. So in previous presentations, I said, well, for the 100/75 Rhino, I would do 3+2, but realistically, because of capital constraints, the scaling in and out has been more granular. So sometimes I start with 2 and I try and get up to 5. Sometimes I stop at 4. Sometimes if I've got capital available, I will start with 3, then +1+1 or +2. So this is the objective, but we don't always manage to get to those levels. So the typical upside hedge for the Rhino is to use a call calendar placed about 1% out of the money. And there's another Rhino that has been called the White Rhino, which never uses call calendars, but that is where the upside hedge is replaced by a called butterfly. And I must admit that, of course, in a very low IV environment, the called butterflies would have done better. But and I also understand that some people don't like calendars. So I would say either or. And probably I would be in the future more prepared to go for more butterfly type of hedges on the upside. The other possibility is to add a put credit spread or a reverse Harvey, depending on capital available. Oh, I see something up there. Okay. All the time, I have to really check the capital. I mean, it has been really something that I have my eyes on all the time, is really how much we can do. And as I'm going to say later on again, the choice of an adjustment or an upside hedge has been determined by, of course, limiting the upside risk, but also doing whatever we can within the capital available. So for better control of the capital usage, I'll often have to do a put condor. So it's actually a short condor. So it's basically, it's a PCS, but I have to roll the low longs up 1 notch, 1 strike, 25 points. So of course, it is less effective, but it uses also less capital. So what I'm going to go now into is when the market actually now leaves the market on the upside, is it always worth chasing it? So what we're going to have a look at now is the rollovers. Okay, I added this slide, typical downside hedges, but of course, if the market goes bearish, I will have another roundtable and discuss about that. But it is not going to be the focus of this presentation. Of course, in my mind, if you have a broken butterfly and eventually, possibly an upside hedge, be it a cold calendar or butterfly or whatever, I try and use the horns, basically the peaks of the tent, as boundaries. The guidelines say, well, we should be using delta as an alert for adjustment, but and I know the skew can help on the downside. So it's maybe not that critical to pass the shorts of the broken wing butterfly, but I would say it's a pre-alert or it's a warning. Especially if the skew is strong, especially particularly at the beginning of the life of the trade, it's not too serious. But as time goes by, the skew tends to dissipate. The top of the T+0 goes closer and closer to the shorts. So it's actually good to have a warning sign around the shorts. So sometimes if I feel the market is just falling and it could actually get worse, I think it's a safe measure to roll the shorts back a little. And if, of course, there can be some preventing method by applying a PDS above the shorts, which will be more effective. But so this is again a matter of capital being used, etc. What I always do is, in case of a flash crash or anything that really goes completely berserk, is that I place a GTC conditional order to buy back one or more short puts. So I try and see what the price will be. So it's not easy to, even with a platform like Option View, to really see what the pricing will be in the event of a market fall. But I try and see more or less how I can preserve a flat T plus 0, or sometimes even make money by going more decisively delta negative. So I at least I place an order to buy back one short puts, but sometimes two, and I sometimes change the order as time goes by. So the hedging alerts are on the upside. In the original guidelines, there was a number for the Rhino itself, but because now sometimes I scale in or I enter one at a time, two at a time, 2 plus 3, 2 plus 1 plus 1. So basically, the delta alert is actually per fly. So on the SPX, it's -10 on the upside, and for the red, it's -5. So on the downside, it's always 25. But as I said earlier, I use a pre-warning because most of the time, because the skew helping, I always try and adjust maybe a little bit early. I know it's not a good recommendation to over adjust, but I'm pretty much cautious when the horn, basically the shorts, are being passed on the downside. Of course, scaling in and out do help keeping the delta flatter. I mean, every time we scale in and out, we choose a new brokering butterfly that will help mitigate the delta risk. So I choose sometimes I change the wing size, or I place the next brokering butterfly slightly more bearish or more bullish, just to make sure. I mean, to place it a bit more bearish generally not only reduces the upside risk, but also increases or sometimes does not even increase the delta. So to keep the delta flat, sometimes I play on the additional brokering butterflies. I would say that overall, as I said earlier, this is the Rhino has become more conservative, and that explains why, to an extent, why the performance has been slightly suboptimal, with only 2% per month, whereas on a normal environment where I could trade closer to the original guidelines, it should make 3 or 4%. But it's been difficult. And also I mean, we all know that we should try and get, because we sell Vega, we short Vega, so we sell volatility. So we try and time our adjustments or scaling in when there's a vol pop. But vol has been sometimes, what is a vol pop? When a vol is down, when the VIX is down to 9 or just over 9, it looks like a VIX at 10 or 10.5 is a vol pop. But you never know. I mean, not so long ago when there was that announcement of the guy who helped President Trump during the campaign, who's been accused of collusion with the Russians, and the market dropped. I mean, well, all of a sudden we had a VIX at 13. So sometimes the adjustment and the scaling or even an entry can be very opportunistic, but you never know when the vol is so low, when and how much it will go back to. I mean, the volatility is supposed to be mean reverting. So the overall long-term average for SPX or for the VIX is 13 and a half, but it looks like a big number today. Something I want to go back to is the rollover risk. And because, of course, we need to learn from the mistakes or the difficult times. This is a very simple. I mean, I know it's almost obvious for most of you, but when the volatility is very low, and if you're already in midlife or towards the end of your trade, the rollover risk can be high. I would say for the November, I rolled in the low IV environment, I would say around midlife, so the risk was high. I took a chance and it didn't work out. But of course, if the volatility is high, I mean, you probably don't really lose on especially when the position is pretty young. And if you roll over, you probably take no loss, and then you reposition it at a good price. So I just want to use this as a reminder that rolling over butterflies can be tricky. It's not exactly the same if you scale in, because you still keep your bottom butterflies in. So scaling in is probably less risky, but when it's an actual rollover, it can be pretty difficult, especially if you have whipsaw or volatility coming back. And also because of capital constraint. I mean, if you want to fight for a trade and you just delaying the next entries, sometimes you just have to take a loss and move on. So what were the remedies I've thought about? I mean, of course, we are all learning. I know various strategies from bearish butterfly, M3. I know I'm not an expert on the RTT, but I know the basics and the concept of it. So, or the Kevlar or other trades. So when something works, I mean, there's nothing wrong with just tapping into it. Another thing, as I said earlier, is that we need to go back to the basics. So the Greeks, how to trade a brokering butterfly strategy with a flatter delta. And something I've come up with is, and I'm not saying that there may not be new benchmarks, new ratios to look at, but what I've seen in a very low IV environment is that a delta Vega ratio is something that helps me look at how a trade can sustain a rising market. Also, something that is, I believe, important is because the call calendars didn't perform. I decided to stick with puts. It could be also an issue with call butterflies, but more specifically with call calendars, the calls have a very different skew than the puts. So if you want to make your trade easier to manage, just stick with puts. So again, I had to think out of the box. I sometimes use a mix of, sometimes when I enter, like I did for the February trade, especially on that event sometime in December when the volatility rose to about 12 or 13, it was a good entry point to enter a normal brokering butterfly, 100/75 wing. But then, as I did in December, January, and sometimes I scale in with a shorter upside wing, so 100/50, or to just mitigate the delta risk. Other possible mutations or changes is to place it more bearishly. I mean, generally, we place the brokering butterflies with the money being covered by the tent. So all the guidelines say, well, we should be at least 10, 20 points below the money. But sometimes also in terms of pricing, risk, upside risk, it can make sense to actually, from day one, place the brokering butterfly slightly out of the money. Of course, we lose on theta, but we gain on upside risk. Another thing that I don't want to risk in the future is to cap the upside risks. So basically, when I enter a trade on a $25,000 planned capital, 4% is $1,000. So I try and keep the upside risk on day one at about $1,000, which is lower than a normal Rhino. On the normal Rhino, we would probably, if you model a typical Rhino on option view or one, you will see that you can have an upside risk that is higher. But considering the skew and considering the market may run away again, and we don't even know where and when the market is going to top. So I'd rather just to avoid, I mean, of course we can enter a trade and the next day or the following week do a reverse Harvey and limit the upside risk. But I thought, well, let's just make sure by entering a mix of maybe 100/75 and 100/50 brokering butterflies, make sure that the upside risk is never more than 4%, and then we work to trade. Something also that I've used more, I mean, I know that old-timers and people who've been trading options for the last 25 years used to swear that, well, it's all about the Greeks and have the Greeks dashboard and you live in a bubble without looking at the market. I've tried now to look more at technical analysis and so using Fibonacci or oscillators or trend following indicators. I think it's important to have a market view more than ever before. So let's go back to call calendar hedges. And I mentioned at the bottom here, don't throw the kitchen sink just yet. The market has forced us to make the Rhino evolve, but it doesn't mean that calendar hedges don't work. Of course, again, some people don't like call calendars. They don't like horizontal spreads. And I can understand that the call skew is slightly more difficult to comprehend. But what I'm saying is that the call calendars do work well in the ranging market. And I've put this little arrow here. And they will work particularly well if when you place the call calendar, the market reaches a local top. I mean, it doesn't, and then retraces from there. The delta flattening, I mean, it flattens delta, of course. And I have realized that it works okay. I mean, a call calendar is supposed to be Vega positive. It may not be as Vega positive as it says. So the modeling in option view and other platforms may be slightly wrong. But again, it doesn't mean that the call calendars don't work. They will work well, as I'm going to say here, especially when the strikes are on a strong or very strong resistance level from which it's going to retrace. I would also say that the horizontal skew must be reasonable. The way volatility pervades through cycles, sometimes it works better, but I mean, of course, it helps if you have the IV of the front leg close to the IV of the back leg. So I would not use, I mean, I know it could be, I wouldn't call it dangerous, or risky, but try and avoid having more than 1% differential in IV, because if the IV of the front leg just shoots up, I mean, and the volatility does not pervade to through to the next cycle, I mean, basically your call calendar is just sinking. So I would need to do more back tests, but I believe that the IV ranking, because maybe the Vega, or there should be a call Vega and a put Vega actually, but anyway, let's say that put calendars do respond to vol shocks a lot better. The put volatility is probably easier to expect and anticipate than the call volatility. And whatever drives the call volatility, I mean, it's another matter. The good thing about call calendars is that they use very little capital. So when you are full size and you are using already $20,000 and you just need to have an upside hedge, and the IV environment is all right, it's a very cheap upside hedge. So because they didn't work out as expected in November, what can we do instead? So if you stick to a regular entry, 175, and you have the skew, so the market is moving up and you need to hedge. If you have already flattened your delta with a put grade spread or a short condor, maybe you can go for a long call. That's something I haven't done, but I know it works. It works with the RTT, so there's no reason why it wouldn't work with the Rhino. But that said, it's only if you have already let your delta build up, and generally, especially in a ranging market, the delta will just build up over time. So if you have let the delta build up, then just buy a 10 to 20 delta call to flatten your delta. And also in a very low IV environment, not only your delta will give a good boost on the way up, but in the low IV environment, providing it does not lose too much due to time decay, it can also give you a bit of Vega boost because it's a Vega positive adjustment, basically. Butterfly hedges, yes, call calendars admittedly may and probably would have fared better in low IV environment, and without again going into the details of what I would call a call Vega versus a put Vega, they do change the way you look at your trade, especially. And this is the same actually for call calendars. When I mentioned earlier that I would be using a new benchmark like a delta over Vega ratio, this works only for the basic combo, the brokering butterflies you start with. If you have a call butterfly, it will make your Vega exposure pretty heavy. So it's not necessarily bad. But if you, contrary to what I say with the call butterfly, which on a retracement will do perfectly well, if the market then retraces pretty abruptly from the I would say the top horn or the second peak of your structure, you may have your structure actually your T+0 sink because of the Vega exposure. So, of course, Vega is, IV is dead. So, but how long will it be dead for? I don't know. So, of course, in the last year, a call butterfly would have done better. Some people just prefer a call butterfly because, of course, you don't have to deal with a horizontal skew. But you have to take, keep in mind that you have a lot more Vega to take care of. So what I've done instead, because I also believe the Vega or the behavior or the response to volatility is easier to deal with put butterflies. So and that's actually not something really new. I mean, I know that even 2 years ago, Brian Larson used put condors to just extend the tent on the upside. So what what I've done in the last 2 months, it could be damage control, or it could be a way to make money, is that I scale in with an additional put butterfly on the upside, which also prevents me from having to roll over the bottom ones. So the put grid spreads, that's pretty simple. I mean, you just cash in some premium, you lift the upper expression line, you flatten your delta. The only thing with a put grid spread is, of course, that it consumes money, it consumes capital. So the typical guideline would say, well, let your delta build up and just cut it by half or up to 2/3. But in the ever grinding market, I've had to do more fine tuning with sometimes PCSs that were just to reduce delta to something flat. But again, always keep in mind that except with upside hedges, for the basic combo, the basic structure, the delta vega ratio is also something I look at. When you do a reverse Harvey, basically pulling back the upper longs, it's better, of course, you get more premium if you do it early. And it's almost, I wouldn't say it's a waste of time, but I mean, it's a lot less efficient if you do it late in the trade. So it can be fine tuning. I mean, once last year, I even ended up with just giving up on the put grid spreads, the put debit spread. So the upper wing was completely disappearing. So it's quite often late in the trade, by pulling back, by doing put grid spreads or even reverse Harveys, you end up with a more unbalanced structure with a lot more put grid spreads than put debit spreads. But and again, it increases your vega exposure quite dramatically. So you must do it with caution, that if you have a vol shock and the market falling, of course it hasn't, because buyers always come back in any dip. But you have to be absolutely aware that, of course, you increase your vega exposure. So let's have a quick look on the two Rhino setups. This one is from July last year. So this is probably not far from the closing. In this instance, what I did is that I let the market run. I had an upside hedge. I think at that time I used a call calendar. And then because I don't like the market to pass that horn, and I don't like either rolling over calendars, which incidentally I did in November, my mistake. It's better just to close it, close your call calendar, close your hedge, and then work on reverse Harveys or other put grid spreads to lift the upper expression line. It's a pretty simple, fairly cautious way of dealing. Of course, the 1 and 2 ASDs are not showing on this because I'm showing the T+0, but I also make sure that my 2 ASD projection at expiration, or 14 DT or 7 DT, is pretty safe. I expect that in this year we'll have probably more blips, more shocks, and probably the profit takings could be pretty abrupt. So it's especially for people who take the trades to expiration, even in the last day, even from the DT1 to settlement the next morning, you can sometimes have a 40 points drop. So it's quite important to always be cautious, and if not 3 ASD, at least have a 2 ASD protection on the downside. So as I said, on that particular instance, I dropped the call calendar and I just lifted the upper expression line with PCSs or reverse Harveys. So as I said, it's my way of trading. I mean, some of the subscribers to the alert service may have chosen to go more delta positive and more aggressive with reverse Harveys, or even sometimes end up with just a PCS by just dropping the whole PDS side of it. But that's not my choice. I choose to remain cautious. So at that time, I used to keep the delta always slightly negative, and maybe also by using 25-point strikes, I don't do very, very fine, minute tuning. I mean, you can always sometimes just do a small 10-point reverse Harvey. That's something that can be done. But again, for simplicity, I stick to 25-point strikes. Something I did for the January trade that is actually expiring next week. I started because IV was low and didn't want to take too much upside risk, especially after losing in November cycle. So this trade was started on the bearish Rhino. So basically the upper longs were at the money or slightly out of the money to make sure that I had very little upside risk. And what I decided on late in the trade, and it had to be late in the trade because I didn't have any capital available because I left December to actually expire. So usually I'd like to scale in by 56 DTE, but if necessary or if I have to, I may sometimes scale in later. And this, I don't have my mouse, so I don't know where I'm pointing, but I used an upper fly just to get a little bit more threat into the trade, and that upper fly actually also helped lifting the upper expression line to 0. So this trade is not going to be making any money, but at least I've got no upside risk. And if the market then decides to reverse quite abruptly to the 2600, it would be fantastic. So the management is just to do reverse Harveys, that additional put butterfly on top. And as I said earlier, always make sure you are covered for 2 or 3 ASD pullbacks. For February, the trade that is still on, I took that screenshot yesterday, so it was 37, so I think today is 37 DT. Same kind of management. This time, because the market has decided to once again run away last week, this time I've decided to go flat but slightly positive delta. Again, I'm telling the members of this group of the alert service that if you want to go more bullish, fine. I mean, but I'm trading this cautiously. So this trade will not lose money. The 2 ASD is in the 2630 area, 2640. So this trade is safe. So we have total peace of mind. We don't have to adjust too often. And as I said earlier, I mean, at least half of the adjustments have been motivated and justified by capital. I mean, usually at this time, we are, 63 DT for March. I should have entered March. And because I don't have capital available because January is still on, I will have to enter later. So again, capital allocation has been pretty difficult. But I've decided that with the market, that can still shoot to 2,800 or above. I don't know, even though I expect the market to be a little bit more volatile and erratic this year. It's actually good to protect both sides. We have virtually no upside risk. We obviously when we take this type of adjustment, we don't respect what would be for me a safe delta Vega ratio. So we do take a chance if the market then crashes to have a temporary drawdown, but the theta will increase and the position will recover, because this trade is probably, I mean, the 2567, so basically where the bottom of the lower structure is, I mean, we have a 7%. So considering I also have a conditional order to buy shorts to lift delta, this trade is pretty safe. And probably, I would say, I mean, I wouldn't put my head on a block and say in all events, but nearly all events. Something that can sometimes be used, I know most traders don't really look at that, but maybe the more advanced traders look at it, is look at the skew. This is also a screenshot of the last few days. No, it can't be January 18th. There's something wrong here. Anyway, what I've seen actually in the last few months is that the vol smile took a lot longer to emerge. Here for January, it's quite visible, but it's also already visible in February, which I believe indicates the volatility is probably go back to normal. It's actually behaving a lot better. In the last 6 months, sometimes we had that downsloping vol curve with absolutely no vol smile. Basically, it was an ATM vol crash. So it also didn't help because the top end of your structure didn't hold at all. So you had your upper longs in your structure being absolutely crushed. I can see that the behavior of volatilities, although okay, it's still in contango, nothing has changed really. But if you look deeper, you see that the vol smile is more present than in the last few months. The way you read it, of course, if SPX goes up, you shift your curve to the left. If SPX goes down, to the right. So you can see more or less where your strikes will be when the market moves. Of course, generally when the IV is being crushed, you have a steepening of the curve. So basically the vol is being crushed at the money and goes up out the money, even more far out of the money. So without going into vol surface and all sorts of fancy charts, you learn to read those charts more accurately. And I must say that the latest additions into Option View are quite helpful. But you also have that in Interactive Brokers. And I forgot about TOS, but I'm sure you have it too. So conclusion. Capital allocation has been pretty difficult. And it is likely to determine in the panel of different adjustments you have in your tool set. Most of the time, you only have one or two choices available because the capital constraints actually dictate what you can and cannot do. I have used also, as I said, when I need to kind of park a trade because I'm still busy with the front month and like now January is still on, and so I didn't have much capital available for February. One way to kind of preserve a trade, I mean, the market is rising, the SPX is leaving the tent. I've noticed that when you in this lower IV environment, when you have a delta Vega ratio of 10%, your trade will probably stay pretty stable. So that's one way when you are short of capital and you need to just park it, as I say, 10% is all right. When IV comes back, I suppose the ratio will have to be increased a little. Of course, you know that if you park the trade, but you are far out of the tent, you have virtually no theta. So sometimes it may make sense just to close the trade and move on. Unless you can then scale out from the previous trade and maybe add, as I've done in January and February, an upper fly just to bring some theta back into the trade. And of course, as as I said earlier, I'm actually tapping into other strategies like the RTT. I'm not copying or mimicking the RTT. The RTT is actually, although it looks simple, it's actually a complex strategy. But just by the risk management on the upside is probably superior. I mean, in the different strategies you have available, the M3, the BB, and Kevlar, all sorts of strategies. I think the RTT is the one that is doing very well. So there's nothing wrong with using some of its management into the Rhino. So what I'm going to be doing if the market stays this way, keep delta flat or flattish to slightly bullish. It's my personal preference. I will not go directional. I will not go decisively bullish. I accept a delta on the variable mode in option view to 3, 4, 5 will be the maximum. So the reason why I'm saying that is that we can just change the way we manage a trade, but it's our mindset. We are delta neutral. We are market neutral traders. So we have to protect ourselves. But I do believe that a directional trader trades very differently. So if you're a directional trader, that's fine, and you probably are doing much better than most of those strategies these days. But this will not last forever. So I think it's also simplicity and balance the way you manage a trade by keeping to your tools, keeping to your mindset. The lesson I've learned is to try and avoid rollovers. I won't go back to that little chart, that little table earlier, but be careful when you do rollovers in very low IV. Okay, so basically, I've been conservative. For some, I may be over conservative, but I'd rather be cautious. If I don't lose in this crazy market, of course, like everyone else, I've got to pay the bills. But making a little is always better than lose a little or lose more. I always keep an eye on support levels. I use a lot of Fibonacci's, range lows, channels, and the 2 SD or sometimes 3 SD projections. The timing has been difficult. Scaling in, as I said earlier, what is a vol pop? When the vol VIX is back to 10, when it was at 930, it's not exactly a vol pop, but because it could go back to 13 or 14. But there has not been any mean reversion in the VIX in the last year. It will happen. Will it be abrupt? Will it be deadly? I don't know. It will happen. So I just have to be, I'd rather be careful, if only just to avoid having large drawdowns, even though my positions are always pretty safe at expiration. Finally, I always say, well, you must ask yourself 1 or 2 questions. To what extent do you want to trade the hedge? If you buy a long call or you hedge with a call calendar, sometimes you keep your combo just to protect yourself on the downside in case of the whipsaw, and it works or sometimes it doesn't. But personally, I don't trade the hedge. The hedge is a hedge. We're still butterfly traders. So I'd rather master the way we manage broker wing butterflies, tweak and change and massage the trade, yes, but at least you know better and better how they work, how they behave. But if you start trading a hedge, basically trading more call butterflies, basically you're learning another trade. So I always have that little warning or advice that, well, of course it's very personal, but I don't really want to trade the hedge that much. same with the delta. How far do you want to go directional? I tend to remain flat to slightly bullish. Of course, as time goes by, if you have kept your bottom structure, your main structure, your broken butterfly on the downside, delta will pick up. So you can go +5 at 30, 35, like we are today for the February trade. I know that within 10 days, the delta will be flat, and probably in the last 2 to 3 weeks, it will turn negative. So it's okay to be bullish for a while, but again, I try and limit my positive delta. And the last word is that there's no perfect strategy. I won't name another strategy that has done pretty bad recently. It would have done well if the market had reversed. Same with the bearish butterfly, same with some trades that are naturally very well hedged on the downside, and of course they do poorly or pretty mediocre or pretty mediocre on the upside. So you want to have a trade and a trade management that adds adaptability to different market conditions. But there's always one trade that thrives better in a particular environment. So the Rhino has been suboptimal in 2017. It did pretty well in 2016. It did very well in 2015, even though we had quite a few hiccups down the line. I mean, at that time, but so if the market stabilizes and ranges, I think the Rhino inherently will return 3, 4, 5, probably more percent per month. So it's and at that time it will probably do better on average than the RTT. So, and I'm not trying to compare. I mean, again, there's no perfect strategy. The Rhino had to evolve, and what I'm saying is that I'm just waiting for the time I can go back to the more original guidelines. So we're making some extension of the trade now, but I'm hoping that if the market then stops and stays in a range. And naturally, the trade, the way it's evolved by not giving up on the downside protection, if the market then retraces, it will be doing okay. Well, that's it. I don't see any.
There were just 2 questions earlier on.
Yeah.
Serge said, do you see them?
I think maybe I should. Oops.
If you just go up to the top, you should see it.
Oh, yes. Chat. Okay. Just missed it. Why, when adding a tranche, what is the 1% trigger? Oh, okay. Yeah, I mean, if the market leaves the 10, so it's 1% above the upper longs. If above the upper longs, you I mean, that's part of the original guidelines, but because of capital constraints, and also something I've added to the trade over a year ago, is that I try and put as much threat into the trade as I can. So I found that the original Rhino was, with capital available, was not optimal in terms of capital allocation. So assuming capital is available, I will add some threat into the trade no matter what. So it makes sense to cover the money. So to add a tent, add to the tent on the upside and add another broken butterfly in the same conditions. So the upper longs above the market, but I will add capital to the market anyhow. What's the second question? When back testing your upcycle hedges, what were your results adding a call verticals? Well, I'm not doing futures. I'm not doing call verticals either. So I haven't tried all those variants. They should work, but at the moment I'm focusing on adding put butterflies. But I think adding a long call is also pretty good. studying how the call calendars behaved, I think adding a long call would be probably my next step before I do cold verticals. Yeah, but of course, cold verticals can be cheaper than just adding a call.
All right, I think that's it, Bruno. We're a little over an hour, so
Oh, perfect. Timing was
yeah,
good.
it was good. Any
Okay.
last words before we wrap it up?
Not for me. No, I'm good.
Okay, well, thanks everyone for coming. Nice presentation. Really enjoyed the analogies with the road trip. The RTT or road trip trade does do well, but in grinding up markets, unless you do things like the long calls that I'm doing, the returns are fairly low. So it's a good maybe to combine the Rhino with the road trip or other trades to have like a portfolio of trades. And some do
Oh,
better in different environments. So maybe
I
something
think
to
so.
think about. Yep.
Yeah.
All right.
Thanks,
Well,
Tom.
thanks, Bruno. Thanks, everyone. I will end the
Okay.
meeting and get the recording posted as soon as I can. So thanks
Okay.
again.
Cool. Thank you, everyone. Thank you. Bye-bye.